What's going on, everyone? In this video, I want to talk about how volatility in the ATR, average true range, really plays a big part in how I trade, especially when it comes to trading the NASDAQ. So when you're talking about trading futures, there can be extreme volatility, extreme range. Today is a prime example to make this video because literally for the first 2 hours, hour of the market, even 2.5 hours, we got little to no movement other than very violent swings to the upside followed by a violent swing to the downside. But the market really wasn't going anywhere. If you look at the chart on the right-hand side of the screen, let me drag this down a little bit. This is my ATR down here, guys. I wanted to just make it a little bigger so you guys can see it, but I'm going to drag it down just a little bit. If you guys kind of look at this range right in here, right in here, okay? This is about the first hour to 2 hours of the market open. This price action is extremely brutal. Like there was setups that were firing for me based on the way that I trade every other candle. Typically, when you start to realize that it's very choppy, you have to ask yourself one thing. Do I really trust this setup? If I take it, meaning I am not going to take any more trades, I'm going to live and die by this setup, or is it not worth it? If it's not worth it, just kind of sit on your hands and patiently wait for something else to kind of happen. But the reason why I wanted to make this video and talk about ATR was the fact that for me, when I'm scalping, okay, and again, the market's changed so much, but we're getting a little bit more back to a scalping kind of environment, okay? Now, typically for me, my scalps are between 10 and 20 points, okay? Depending on the range is going to determine whether I'm looking for 10 points or I'm looking for 20 points. And sometimes I've gone down to even taking 5 or 6 points, 7 points out of the markets if it's, really starting to stall out. So the point is that when I started to really identify, okay, in that first 30 minutes, that first 45 minutes that the market was going to be choppy, I had to pull my foot off the gas. I had to actually take a break for about 30 minutes. I even told all of my people in the Evolution Traders community, hey guys, if I continue to sit here and watch this price action, it's going to force me to take trades because I'm going to start anticipating moves, and that's going to be a very, very big problem. So let me just kind of come back in about 30 minutes with a fresh set of eyes, and maybe something happens. But the ATR, for me, if I'm scalping the 5-minute time frame, I really don't like to see ATR over 30, 35, 40. Okay. Now, again, there was about a period of time a month ago where you were looking at 100.5-minute candles every other candle, right? Those moves are a little bit different because you can kind of get into these quick scalps, and especially if you're only taking like 10 points, you have a higher probability to get filled. The point that I want to make with this video is that when you establish that the market is not doing anything, right? Like the 30-minute range was set, and those are the dotted lines that you see on the screen. That's a 30-minute range. When you see that we're kind of not taking out the highs, we're not taking out the lows, we're not really just trading and consolidating at the lows for a breakdown, we're not consolidating at the highs for a breakout, and you're just kind of stuck in the middle for 20 minutes, 30 minutes, 40 minutes, an hour, you got to tell yourself this: what's the ATR? Because if you're going to get a setup in this chop, okay, and the ATR, and again, this is my opinion, but if the ATR is 30, 35, 40, which at this time, if you kind of look at some of these candlesticks from high to low, we're talking about 30 points, 35 points, 32 points, and if that's the average, but if you look at some of these candlesticks, this is a 57-point range, just literally up and down doji. This is a 40-point candle, literally goes nowhere, up and down doji, right? Like just a little doji candle. Like these are not going anywhere, but they're 40, 50 points from high to low. So if you're getting in on a scalp, and let's say you're still coming to terms with, is the market going to be choppy today, or are we going to get follow through? And you're entering on, let's say, a breakout over a structure high or a previous swing, swing high, and you have a candle that's going 40, 50 points and the ATR is sitting at 30, 35. If you're wrong and the market's going to pull back, it's going to pull back 35 points. It's going to pull back out of that 40, 50 point range candle. It's going to pull back 30 points, 32 points, 31 points. And that's not going to feel too good, especially if the market is ranging. So how do we kind of fix that? Well, if you come into the session and you kind of see that, you know what, 30 minutes has passed, 40 minutes, 45 minutes has passed. There's no sense of direction here in the market. And the ATR is a little high, 30, 35, 40. I'm looking at candlesticks that are 50 points and essentially going nowhere. You have to literally sit on your hands until ATR drops. So that might be lunchtime. That might be sitting out until after lunch. Because after lunch, coming out of lunch, there was a beautiful sweep of the 30-minute opening range, followed by no confirmation to go higher. And then you get this nice breakdown through this structure. You see this green box that I drew on the screen. I was on a call with the traders and Evolution Traders community, and once we started to really break through here, we had a stop loss over 380s, which is here, and we kind of just sat in this trying to target all of this nasty price action down here, right? So that trade worked a little bit more seamless. And if you look, even though the candlesticks, yeah, they look pretty large, the ATR at this time, starting from literally when we lost the 20 SMA, the ATR is only sitting at 25. The ATR is sitting at, 24, 23 even. So the ATR is less, right? Average true range is less here in a big trending move down than the average true range was here when the market was literally going nowhere. Now, we all understand that off the open, there's a lot more volatility. So we know that the ATR is probably going to be a little bit larger. But if the market's not going anywhere, why do you want to fight a market that's literally going up and down and barcoding to the side in a much bigger range if it's not trending? Now, if the market, let's say it pushes up higher, it pulls back, stays, 50, 40% of the top of the range, starts to just grind higher here, and the volatility is a little higher, or the ATR is 30 or 40 points, and we kind of break out of the high of day, then yeah, there's opportunities for a pullback, get in off the pullback and continue to ride the bounce, get in off the bounce and continue to ride the upside. But when the market's not doing anything, and again, you have to get really good at trying to identify and trying to establish that, hey, this market is trying to find a trend, but nothing's happening, or this market is trending. And as soon as you identify that, there's one of two things to do. The market's not trending and it's chopping sideways, I gotta hold off. ATR is way too big. The volatility and the ranges are way too big for me, because if I'm gonna be buying long at the upper extremes or going short at the lower extremes, I'm going to get absolutely diced. Like in these periods of time, and it's not easy to do, your best bet is just to start firing long in here. And your best bet is to start firing short in here and just kind of playing these little drops and playing these little pops and play. That drives me absolutely nuts, though. It's very, very hard to do. I more so like to see when markets kind of break out and fail, and then I can use a definitive structure high as a stop like we did here, and then kind of just ride it back down. I like to see when, the market, let's say we're pushing up on this uptrend and then it fails to kind of get back over, maybe spikes one more time, and then starts to lose, let's say, this trend line, and then starts to come crashing down through that low. I like playing markets like that when volatility in the average true range is a little less. So here's my opinion. If the ATR on a 5-minute time frame, if you're going to scalp a 5-minute time frame, if the ATR is over 30, 35, 40 points, and the market is not trending in one direction, you're probably better pulling your foot all the way off the gas until volatility gets back into the mid 20s, low 20s, mid to low 20s, because you're going to be able to manage your risk a lot easier. It's very, very hard to manage your risk when you're looking at 50, 40, 60 point candles in an ATR of 35 in a sideways market. It's literally almost impossible to not get chopped up. And again, hand to sky, did I win every single trade today? Absolutely not. Absolutely not. I lost 3 or 4 trades today. Very small losses, just quickly got out when I seen it wasn't having any more follow through. But the wins that we were able to catch were a little bit bigger than the losses. And again, a lot of my losses, 3 of those losses came in this period of time, right? When the market's trying to break out, pulling back, and then looks like it's going to go higher and then falls down, right? when the market looks like, hey, you know what, we kind of got rejected here once, we got rejected here twice, maybe we're going to start to break this trend line, it breaks by a tad and then quickly bounces. Look at this trade here. Look at how we have an upwards trend line, we have a closure below the 20 SMA, we have a definitive rejection here, a definitive confirmation wick here, and then bounces. Normally, if there's going to be follow through, this is just going to get absolutely obliterated. That 30-minute opening range is going to get smashed. It's going to create another setup to the downside, and you're going to have a lot of continuation there. So that's what I'm saying. It's very hard to identify the channels. So I did take a couple paper cut losses in this range, and it wasn't really until, okay, we broke out of this range to the top side, we consolidated, we kind of broke out, back tested, and I got long in this range, and we actually rode this through the 30-minute opening range. Now, we didn't sell all the way at 419. I think I sold closer to 405. That was what I was targeting. The reason I was targeting 405 was I was just targeting the high of day. The high of day was 21,405. I actually sold it like 404 and a half. Like I didn't want no part of this market, to be honest. But once we got that clear rejection and then we started to fall back down, now I've got some structure to work with. Now I'm looking at my ATR down here sitting at 22, 23. This is going to be a lot easier to manage this price action because the ranges are not so big. And as soon as we started to lose this little mini floor here, now I can kind of get short and I can use this little swing structure high as a stop and it caught a really big trade here. So a couple of these paper cut losses, if I just allow myself to go into big, dark, deep drawdown, these two winning trades would have not really accounted for anything and probably would have put me on emotional tilt because I made really good trades, but the losses were so big. Because the losses were so small early in the day, I did have a couple of winners in there as well. So the P&L wasn't super bad. Like I was always pretty profitable, meaning like at one point in time when I took a couple of these losses, I came out of this range like net positive $70, right? Like $80, which is fine. Like I'll take that. Like if I can escape that heat and still be positive, that's fine. Because when you do catch a move, now you can actually ride it. When you do catch a move, now you can actually ride it. I kind of stayed out of all this price action here because by the time I made money on this downswing, I played this short 3 times. I got short here, I got short through the trend line break, and then I added onto that trend line break and then tried to sell as close to the bottom as possible as we started to drive into that 30-minute opening range low. Now, again, by that time, you're just so mentally exhausted. It is what it is. But pay attention to your ATR, guys. If the market is barcoding and the ATR on a 5-minute time frame is over 30, over 35, over 40, your best bet is to stay off of the charts until the ATR dies. Let it come back down into the mid 25s, into the mid to high 20s, low 20s. Those are all good numbers. Even if it's like 18 or 15, that's super good because now you can actually breathe in the trade without having to like quickly get in and out. If the ATR is too big and you're inside of a channel, which this is a channel, this was a 30-minute opening range channel. If the ATR is too large inside of a channel and it's not really going higher or lower like it was this morning, you're going to get chopped up. So you're better off waiting until ATR dies so you can now manage that position easier. I hope that makes sense. Like, comment, and subscribe if you guys want to join the Discord. That link is down in the description box below. Comes with my course. All my strategies are in there. Also comes with live trading multiple days a week. Comes with technical analysis levels that I'm looking at each and every single day. And a great community of people. I also offer a 30-day bootcamp mentorship that's in there as well. So you guys can check that out. Apex is 80% off as well, guys. Got to do some housekeeping. 80% off. You can use code DAnthony for those evaluations. I'll see all of you guys on the inside.